Good afternoon. My name is Shawn Hirsch, and I'm a partner with Signet Financial Management. I want to personally thank each one of you for joining today's call. Today we'll have Steve Tuttle, Chief Investment Strategist of Signet Financial Management, discussing investing during the election years. Steve has been with Signet for about 20 years now and has about 30 years of industry experience overall. He's a great resource for our clients, as many of you know, and I hope you find this webinar very informative. In speaking with many of my clients, I know the upcoming U.S. elections are very relevant to investors. I hope that this webinar brings some clarity and conviction to each one of your individual situations. Steve will present for about 15 minutes or so, followed by a brief question and answer session based on questions that were submitted to us prior to this call. You will remain muted during the webinar for better audio reception. If you do have any questions, I encourage you to reach out to your advisor or Steve following the webinar. Steve, I'm going to now turn this over to you, and thank you.
Thanks, Shawn, and thank you everyone for joining us today. Hopefully, we'll be able to cover the topics Shawn mentioned and make this a very informative and useful presentation. So presidential election years are certainly unique, and there's definitely some concern among investors about this year in particular. And if you're nervous about the markets, you're certainly not alone. I'm going to cover some data that maybe will help you feel a little bit more at ease. But I think it also might bring to the attention that based on history, the returns that you can expect in election years are actually fairly positive, and that might paint a different picture than what we expect and what you're hearing now in the markets. So the first few slides are just going to be some nice charts, and it's just going to refer back to history. And the first slide here shows how stocks have behaved during the election years. It goes back to 1964, and you can see there's a lot of blue lines that are on the positive side. Just 2 years that were negative if you go back all those years. In fact, since 1964, the average return in the presidential election year has been over 7%. And you can also tell by the number of positive years that the odds of earning positive returns during election years are actually a lot higher in election years than in all other years combined. The only two down years were in 2000, the tech bubble, and 2008, the financial crisis. And I point this out because I think it's important to consider perhaps it's not the election or who gets elected president that drives the market returns. Perhaps it's other circumstances. Perhaps it's what's going on in the economy and the business cycle. And certainly in 2000 and 2008, those were very unique years. So if you average up the presidential terms by each year, first year, second year, tend to be lower in terms of returns that you receive on average. And the last 2 years of a presidential term, we're in the fourth year of a presidential term, are much higher. In fact, the fourth year of the presidential term has been the highest on average if you go back in history. Continuing with the idea of the presidential cycle, I'm showing a pretty complicated chart here, and I'm not trying to get you to decipher between the different color lines on the page. What I'm trying to show through this chart is a pattern. The pattern is that markets on average have generally risen no matter who wins or how you slice and dice the elections. So whether it's a Republican president with a Republican Congress, or with a divided Congress, or a Democratic president with a divided Congress, whether it's a new candidate, whether it's a returning candidate, the fact of the matter is, over that 4-year term, the market generally goes up. And the pattern can be a little bit different. There can be a couple rough bumps there that you definitely see. But after that 4-year period of time, over time, the market has been higher. So why is that? Why doesn't it matter as much as we think who is in the White House? Well, a big driver, I think, is fundamentals. I mean, we have done a lot of research in this area, and we firmly believe that it's the fundamentals that drive long-term returns. What are corporations doing? How are their revenues? What are they earning? What are interest rates? What's that environment look like? How are wages and labor and productivity? What's the Fed doing? What's the central bank policy? What are valuations of the marketplace? So while the political noise can swing up or down, it always comes back to fundamentals in our opinion. When I was doing research for this presentation, one interesting point that I found, it was actually during the last presidential election, but there is some predictability in the stock market in terms of who's going to get elected. So polls we've found are not great predictors of who's going to win the election, and the election results aren't great predictors of how the market is going to do. But if you look at how the stock market performs 3 months before the election, if it's positive, generally the incumbent wins. If it's negative, the incumbent loses. And since 1928, the stats say this has been a correct predictor 87% of the time. So that's certainly pretty interesting. So I've talked general and I've talked stats and charts. Let's get a little bit more specific about what's going on in the world today. There's a lot of uncertainty, and there's three main sources of risk that I think are dominating the headlines and to some extent the markets. The first is taxes, individual and corporate taxes. There's definitely a belief that if Biden wins, individual and corporate taxes will go up. And that is believed to be negative for corporate earnings and negative for the economy. On the bottom here, there's also a belief that if Biden wins, the U.S.-China trade relations may improve. That actually would have a boost to earnings and a boost to GDP. And the reason I point these two out is because that seems to be the common fear. Biden is ahead in the polls right now. What is that type of a dramatic change going to do to the markets? And so on the one hand, taxes may go up, that's negative. On the other hand, foreign relations and trade might improve, that's a positive. The two offset each other out. And so while there could be a negative influence overall, it's by no means as dramatic as you might think if you're looking at just one part of the equation. So what's that left? The other main source of risk, which has nothing to do with the elections, or very little anyway, and that's the spread of the COVID-19 virus. And the big concern with the spread of the COVID virus is how fast can we open the economy? And we don't have any control over that. That's a huge area of uncertainty, but it's not something that we can control, and I don't think it has very much to do with the elections. So things aren't all negative. There's also some very good reasons for optimism. The first is the old saying, don't fight the Fed. We've seen this year massive support from the U.S. Federal Reserve, and that has definitely helped the economy start moving again, and it definitely helped the stock market and the bond market rebound off their lows from March. Fiscal stimulus. We've already seen one major support package come from Congress, and in the next few weeks, it's likely from $1 to $1.5 trillion of support is also going to be coming to help prop up and boost consumers and the economy. Vaccine progress. Lately, there's been some positive news and some positive stories and positive developments about vaccine and treatment options for handling the COVID-19 virus. So that's definitely positive. And finally, corporate earnings seem to be bottoming. And it's not necessarily a case of corporate earnings are fantastic, but it's more a case of, given that markets are forward-looking, if markets and corporations announce earnings that are not as bad as expected, if they're better than those worst-case scenarios, which we heard about a few months ago, stocks actually go up. And so what we've seen is on the announcements that that have come out on the S&P 500 companies so far, they've actually been surprising to the upside for the most part. And so all of these areas are definite strong reasons for optimism. So what do we do as an investor? How do we handle the uncertainty? And is there anything specifically that we should be doing this year in an election year? Well, I think there's three common mistakes that investors make, and they seem to happen like clockwork every 4 years. I've been doing this quite a long time, and I see this every election cycle. Number one, worry too much about who wins. I just showed a lot of data and some charts which show that perhaps who's in the White House doesn't have as much influence on the financial markets as you might think. Two, you get spooked by primary season volatility. Keep in mind what politicians are trying to do at this point in time. They're trying to generate coverage. They're trying to generate attention, and they're trying to make themselves look good. So you tend to see a lot of negative announcements. You see a lot of negativity coming through the politicians and the media. And keep in mind that that's part of the political process. So maybe the concerns are exaggerated. And the third mistake that is very common is trying to time the market around elections. Well, I'll just go to cash, wait till the elections are done, and then I'll get reinvested again. Well, I just showed a lot of slides that showed if you went to cash every election year, you missed out on a lot of upside return, a lot, over 7% a year. And you would have missed out on that in all but 2 of the election years going back to 1964. So trying to time the markets is probably a strategy that's going to hurt you more than help you. So what can we do to help avoid these mistakes? How can Signet Financial or your financial advisor help you? Well, one, try not to allow the election predictions and outcomes influence your investment decisions. This is not easy. It's not exactly how the human mind is wired. But focus on fundamentals, focus on your unique circumstances, and how best to achieve your goals. A short-term change in the political system is not likely to change your financial goals. And if it doesn't change your financial goals, odds are you shouldn't be changing your investment strategy based on what polls are saying or based on which political party is in office. Expect volatility. It's going to happen. We've already seen a lot of volatility this year. There's most likely more to come. But don't fear it. Volatility is a part of investing. It's unavoidable. I'll also note that the best investors, the one who are able to generate the highest returns over time, are the investors that are able to endure volatility and endure uncertainty, not the investors that try to avoid it and miss out on returns as a course of action. So expect volatility, don't fear it, use it as an opportunity to create new sources of return, to rebalance, and to keep you on track to achieving your goals. And finally, this is related and pretty much underlies everything we do here at Signet. Stick to your long-term investment strategy instead of making abrupt changes around elections. The elections are not going to drive the returns in the market over the next 10 years. That's just not the way our economy and our financial markets work. So I'll sum up pretty quickly. I tried to cover a lot of material fairly quickly, but here's the key takeaway for me. One, there are some patterns between how the market behaves in presidential elections. But contrary to what we might feel right now, the trends are positive. The patterns are positive. Markets usually go up, particularly in election years. So we feel strongly, well, you may feel strongly about one party or the other when it comes to your politics, and that's fine. It's great to be involved in politics and how our country is run. But when it comes to investing, when it comes to your portfolio, we think the best advice is to put your politics aside. Stick with a broadly diversified portfolio. Focus on achieving your unique financial goals. And if it's properly constructed, and if you're a client of ours, I have a high degree of confidence saying your portfolio is properly constructed, you'll be fine regardless of who wins in November. And that's really, at the end of the day, what we're trying to achieve here. So, Shawn, that's all I have. I know you have some questions. I know you speak to a lot of clients. What do you got?
Perfect. Yeah, so if we have time for three, we'll do three, but I'll start with one and we'll go from there. So the first question that we got was, I would like to know if Signet Financial would notify clients who are in a retirement account like myself when it would be prudent to move to a more defensive stance by rebalancing to protect principal if a substantial correction is looming in the near future. I know you have that crystal ball.
The crystal ball. We don't often speak about the crystal ball, but I've got news for everybody. It doesn't exist. And I've been doing this quite a while, and I'm always concerned about downside. If anything, I'm more of a risk manager than someone who's looking to maximize return. And I've been through several ugly bear markets. Not once have I gotten that phone call that tells me ahead of time that the bear market's about to start. And so the answer that I would have to that is, one, markets are not predictable. That's the one consistent part about markets. They're not predictable. So instead of trying to predict when markets are going to sell off, I think it's better to plan for the inevitable. At some point, markets are going to sell off. So be properly diversified and have a plan that might be as simple as, I have some of my portfolio in bonds, which should do well if the market sells off. I should have some of my portfolio in stocks, which might get hurt if the market sells off. And you rebalance. I mean, clients that we did this for this year, in March, we were rebalancing. Stocks sold off, bonds went up. You take some profits off the bond side, you add them to the stock side. And it doesn't always work this way, but 3 months later, the market is significantly higher, and now we're being prompted to rebalance again, to take some profits in stocks, shift it over towards bonds. Neither of these transactions are a function of what we expect to happen over the next month or two. They're a function of our discipline and risk management. So my advice is make sure that your portfolio is structured properly. Make sure that the risk you have in your portfolio, that you understand it and that you're comfortable with it. And if you're not, if your portfolio has been too volatile this year, speak to your advisor and let's see if we can do things to take a little bit of risk off the table, not just for the next month or two, but for the next 3 to 5 years. And the other side of that is, what type of return do you need? And if you need a higher return, a more conservative approach would have some challenges. So try not to predict the markets. We do have a plan to react to whatever the market throws at us. And that's the main message.
All right. Number two was, and this was from a bunch of clients, isn't this year different than the past elections?
Yeah, good question. Very common question. In fact, it's so common. I remember speaking and answering this question 4 years ago, and 4 years prior to that, and 4 years prior to that. And I'm making a little bit of a joke of it, but the fact of the matter is, every election is different, and every election seems more important than the last. And that's kind of a function of our society. There certainly seems to be a lot at stake this year. But like I said, markets aren't predictable. And every single election, the circumstances are a little different, but there's also some things are the same. One thing that's the same is that we can't predict who's going to get elected. We can't predict how the market's going to react if they get elected. So stay away from trying to do that. We can control our response to uncertainty. We can control how we process new information, but try not to predict what that new information will be. So the best course of action, even in this year, where we think it's more important than ever before, is to, one, remember all those slides I showed. There were a lot of important things happening in many of those elections, but yet the trend was the same every election year. The market generally went up. And plan for a range of outcomes. one consequence of an election year with a virus pandemic happening is that maybe there's a wider range of outcomes this year than in the past. I'll agree to that. So you want to have a portfolio that can handle that, and that means more diversification. That means having multiple sources of return, and that also means having some flexibility to rebalance and to make subtle changes if needed based on what happens in the marketplace. And we're prepared to do all that for our clients. I think we have time for one more quick question.
Okay, perfect. So the final one's then going to be, do you plan to make changes to my portfolio based on who is elected?
Okay. Another good question. I'll say this: presidential term is 4 years. So over the next 4 years, absolutely, we plan on making some changes to your portfolio. There will be some good reasons to make some changes as we navigate, the changing environment. The fundamentals are going to change. But I can't tell you right now what those changes will be exactly. I don't recommend making abrupt changes to your portfolio now based solely on what the polls say and what the pundits say is going to happen if Biden wins or if Trump wins. I think that's not going to reward you. I think it's best, even after the election comes out, maybe to wait for the actual legislative action to happen. I mean, one thing that's very typical of elections is that the message changes once a new president is in office. And by that, I mean, when you're on the political trail, it's easy to make claims and it's easy to have bold plans. But one of the things to remember about our political system is it's designed very specifically to make it difficult to enact major changes. So very often, the changes that take place are much less dramatic than what we're hearing right now. And so keep that in mind. And I'll end with just a reminder that investing is all about the big picture, right? If your goals don't change, if your financial needs don't change based on the results of this political election, if they don't change based on who is president, and I don't expect that would change your financial goals, then changing your portfolio probably isn't warranted. Stay disciplined, stick to our process, and we will make changes when the fundamentals tell us there's opportunity or tell us that there's a way to generate the return you need with less risk. That's what we're always looking for. That's the key. So I think that's all the time we had for today. Shawn, do you want to wrap up?
Yeah, perfect. So thanks so much, Steve. Really appreciate it. So yeah, I mean, I'll just say this quickly is that, as far as what our advice is, even though it seems fairly simple, it's just not easy to follow, right? We're emotional creatures. So the best course of action might be different for each individual client, depending on your specific circumstances. If you're uncomfortable with your portfolio or have any questions, Steve, myself, your advisor, we just encourage you to reach out to us, please. It's what we're good at. It's what we enjoy. It's why we're in the business. And it's one of the biggest values we think we bring to the relationship. So we'll help you make informed decisions. We're not emotional. We're evidence-based, and we're longer-term focused. So stick to the plan, and we've been doing this for many years. I want to thank each of you for attending today's webinar, and we hope you enjoyed it. Have a great rest of your week and weekend, and hopefully we'll see you around soon.
Thank you.